We had the worst inflation in history and the history of our country. I mean, we had months where it was 9 and 10%. And now we have a report just came out. The report was incredible. Inflation is way down. That means prices are coming way down, and we're doing a great job. Remember that for the midterms, I say to that camera. Remember that, because nobody else could do it. Prices are way down. Prices are coming way down, and we're going to bring them much lower yet.
All right, so you heard it there. President Trump cheering the latest inflation numbers as the June CPI report showed prices starting to cool just a little bit. But right now, oil ticking higher as the conflict with Iran reignites. Welcome back to the second hour of the Big Money Show. I'm Taylor Riggs, along with my wonderful co-host. And with us for the hour, Baird Strategas Chairman and CEO, Jason Triner. So great to have you as always.
It's so great to be here. Thanks for having me.
So the president is ordering a full blockade on any ships linked to Iran while dropping his proposed transit fee in favor of new trade and investment deals with the Gulf states.
Saudi Arabia, UAE, Qatar, Bahrain, and Kuwait, primarily, and then others. I spoke to all of them, and they would love to invest more money in the United States at record amounts. And that would be very acceptable. And this way, there's no fee. I don't like the concept of a fee. But at the same time, it's not fair that we're protecting this strait for the entire world, for China and everyone.
I want to dig into that with you, Jason, because we were talking yesterday and today, a debate about the 20% toll or the 20% fee that we were going to take. And then you heard from the president, he doesn't like the fee, but instead the Gulf nations said that they'll invest in the U.S. instead of that. But I think the bigger question that the president highlighted for me is we are spending money to protect everyone in the Gulf. What do we get back for it when we always show up? NATO does not. How do you sort of glean all of this, and then you can tie in sort of the economy and oil markets as you always do?
It's a toughie, obviously, because the international rules-based order, which is basically like America pays for everything, security has been around, obviously, since the end of World War II. President Trump has changed that since 2016, but old habits die hard, right? And I think it's going to be, it's a little politically, internationally politically, it's going to be difficult to make the case to get a lot of backup here.
Yeah.
As far as the markets are concerned, it's all about the price of oil. I've thought about this every way till Sunday. There's really just one number that really boils everything down in terms of where we are in terms of the negotiations and its impact on the economy and the markets. All the other brain damage you can do in terms of where we are in the negotiations, doesn't seem like it makes much difference because one side is not negotiating in good faith. So whatever you hear, it just seems like 24 or 48 hours later, there's a change in plan. So I've kind of reduced this down to watching the price of oil and hoping for the best. But oil is a global price, so it's something that it does affect everyone.
I'm curious if you have a number on oil. We heard from a lot of the banks this morning, and it was Brian Moynihan, I think, that sounded to me surprised. This is a consumer economy and they keep spending. Even in the face of higher oil prices, they're still seeing the consumer and their bank show up and spend. Now, maybe we could argue, are they spending on credit and debt, or are they just spending because they can and they have the wherewithal? Is there a number on oil where you start to see sort of that demand destruction, or are you surprised that consumers still are showing up and this is a consumer-led economy?
I'm a little surprised, I have to say, that didn't have as big an impact on the U.S. As it might have had. I'm also surprised how quickly oil prices came down when the memorandum of understanding was signed. So I think the answer is clearly higher than 90 to 100 because the economy is doing just fine. Now, lower is better, obviously, but 80 to 85, it seems to me very reasonable because we've already tested that, that theory. The economy as a whole is in great shape. I mean, by any normal standards, you're looking at what, when I came out of college, full employment was like 6% unemployment or 6.5% unemployment. You're in the low 4s right now. Unemployment claims are 200,000 a week. which is minimal. You have stock market obviously at all-time highs, and also with the inflation numbers this morning, you can see that real incomes are actually starting to rise a bit. So I have to say, you have to take, it's not perfect, but it's a human system, so it's never going to be perfect. But on the whole, I think the economy is quite strong. And the one big beautiful bill, which doesn't get enough credit in my opinion, is having an impact on the economy this year. People are very focused on capital spending on AI, which I understand, but that's also benefiting from one big beautiful bill. They would have probably spent anyway, but there's a lot of other companies that might not have spent if it weren't for the one big beautiful bill.
So Dagan, let me bring you in here and we can all debate this. I think what I'm trying to figure out is if this is a strong economy, even in the face of Iran, even in the face of tariffs a year ago, because the benefits of the big beautiful bill, I get excited that we're talking about the AI CapEx numbers. Now, some people might say, and maybe you've talked about this, we don't want an economy that's solely dependent on AI. When it's 2%, two companies that are dependent on 40% of the profits in the S&P 500 or whatever that number was that you were saying, part of me gets nervous that I don't want to be only dependent on an AI trade that could crack and fall. But the other part of me is thinking, but if AI is the future, this will be an economy built on AI, and therefore AI will be the foundation for what we do. And if that means that it's focused on AI right now, that's fine. That's the future. It doesn't mean that we're at risk of a big crack.
That was to give credit where credit is due. It was Ryan Grabinsky from Strategas that I was quoting, that's just a valuation issue and a concentration issue for the market, where he wrote recently 20 stocks account for 95% of second quarter earnings growth, with Micron and Nvidia combined accounting for it's more than 40% of the growth. And so I can, go into the valuations. Are they bubblicious? If you add up, look at the value of all the AI companies, how much would they have to earn to carry a reasonable valuation? And it is multiples of what the total earnings of our most valuable tech companies are. It's just not realistic. That being said, as an industry, pray to the high heavens that artificial intelligence works, because we need super fast artificial intelligence growth. We need the productivity from it. We need inflation easing and even dropping because of robots and these efficiencies, and also the growth that comes out of all these new businesses that will probably be formed in these incredible, purely American innovations, because we need a way to grind our way out of the debt load that we're carrying as a nation right now, and grind our way out of the fact that we're on the cusp. If interest rates move higher, our interest expense is going to swamp Social Security. It will be the #1 expense for this nation, just paying the interest on our credit cards, for that matter. So pray. Growth is the way, but it's still going to be a grind.
Jackie, how do you think about all of this, and also the headlines out of Iran as well, and markets seemingly today not reacting?
That's exactly what I was thinking, because we just had the chip stocks up, and you had green pretty much across the board. And so, I mean, whether the yield on the 10-year is over 4.5% or not, I hear you, Dagan, on all that, but for some reason the market is kind of shrugging all this off, even with oil back around the $80 mark. So that, I mean, there are days when this happens that I am mystified by it, because I don't think that should be the case, but yet for some reason it is. So I go back to Charlie's thesis in the A block, which was that Trump doesn't have any cohesive strategy. I don't believe that. I agree with you, Brian, that he's just not broadcasting it to us, and that there will be a resolution to this. Then the big, beautiful bill will be back in focus. Maybe they could do some second version of that that would be more stimulative for the economy and growth. Larry says he'll be on tomorrow. We could grow our way out of some of the problems.
He also says debt is as American as apple pie.
Well, that part I don't, but so. And I think the market thinks everything is right now. It's copacetic.
Well, debt and deficits don't matter until they do matter.
Until they do,
right? Just like you know,
That's
oh,
fair.
I don't need insurance.
Until you do.
Right.
Until you get hit by the car.
Because I'm not going to, my house isn't going to get hit by a hurricane, and then it does.
Brian, come on.
On hurricane. Okay. Oil is at $79 a barrel, and we're in full-fledged war with Iran. I think that tells you something about the way markets think about where we're going with this. I read a piece, I can't remember where it was, talking about what Iran's doing in terms of its attacks, okay? And the piece made the point that in the early part of the war, the attacks that Iran was making made some sense because they were going after targets that would eventually allow them to go more fully after Israel, okay? They're kind of doing the same thing now that they were doing then, and this commentator said that doesn't make any sense given where they are. This looks more like desperation out of them than it looks like a strategy. And I agree with that. The president is, you know, we've debated it the first hour, and he's got lots of critics, and they don't like the fact that one day he says 20% and the next day he doesn't, okay? Right. They say that's not a strategy, that's just blowing in the wind. I don't know his strategy, but him doing that is not evidence of a lack of strategy, okay? The guy has tools at his disposal, and he uses them when he sees an opportunity where he thinks they'll make an impact. He's got blockades, he's got sanctions, he's got dropping bombs, he's got other things. And he uses them as circumstances permit, which I think is how he did a lot of things in life and in business, okay? So all I'm saying there is I'm watching key indicators. Crude's below 79 now, I guess, okay? I'm watching key indicators, and I'm asking myself, people with money on the line in these key commodities, what do they think about the future? And I think their view of the future is Iran's going to fold and oil's going to flow.
Can I make one point about what he said? I'm sorry. It just really quick. So that just made me think, like, what he does is he floats it. First of all, he floats it because if he puts a 20% toll charge, whatever, on and people go along with it, then okay, fine. We don't have any problem. The second thing is he thinks to himself, well, if they don't go along with it, they're going to call me to hem and haw. That gets people on the phone.
There you go.
They start talking.
Yes.
They start negotiating. The more you're talking to people with a reason to have to talk to them, especially within that region, the more you know what's going on and the more opportunity you have. So sometimes it's like he puts the 20% out there to get something completely different that you wouldn't expect. You know what I mean?
Yes.
Like,
that's what I think he does. You can like it or hate it,
it,
but that's what he does. Like, that's how he gets things moving. Instead of going to Delaware and sitting on the beach in the sand, he does things to get conversations going.
Really quickly, if you listen to Kevin Warsh and the president, they are very careful, that piece of sound that we played from the president leading into this block, to reinforce and reinforce and reinforce their attention to inflation, to try and keep inflation expectations in check, because they know that it can get away from you. And the 5-year inflation break even, it was at 272 in early May, and it fell dramatically and bottomed out at 219, and it's crept back up. It was at 231 yesterday. But that is the most important thing, is like, what do investors expect, and how are they laying their money on the line?
Yeah, we watch inflationary expectations very carefully, especially at 10 years out. But also, you know, jawboning is part of the Fed's policy toolkit. Now, Chairman Warsh really doesn't want to use forward guidance, right, which I agree with completely. By the same token, there's really no harm in talking a bit hawkishly or suggesting that you are watching inflation very carefully. Actual tightening is a different story, but generally speaking, the Fed does not tighten without warning. And because then it works across purposes what they're trying to achieve, because then somebody gets caught off sides, a hedge fund, something like that. Right. They want people to be aware, and also, as you're pointing out, anchor inflationary expectations.
Hold that thought, because I want to do that in the next block, where we're doing a lot of Chair Fed Warsh stuff as well. His testimony today I thought was great.